Hi there, welcome once again to the Dukascopy TV studio. I'm Ben Jones, and alongside me today to discuss investment in Vietnam is Kevin Snowball. Kevin, thank you very much for joining us.
Pleasure.
So, if we can begin by discussing your organisation, your personal involvement, and can you just give us a bit of background information for investment in Vietnam?
Of course. Well, PXP Vietnam Asset Management, which you see the logo for here, is the management company of PXP Vietnam Fund and PXP Vietnam Emerging Equity Fund, plus a segregated mandate for a European institution. We manage in total about $160 million. Purely focused on Vietnam listed equities, or almost entirely focused on Vietnam listed equities. I'm the founder. I moved to Vietnam in August 2000 to set up what became PXP Vietnam Asset Management. We started managing PXP Vietnam Fund on the 31st of December 2003, so we're sort of 10 and a half years, or just over 10 and a half years into managing money in Vietnam. And given that the Vietnam Stock Exchange has only existed since July 2000, we're only 2.5 years behind it, essentially. In terms of investing in Vietnam, when we started, Vietnam had one stock market. It had 22 listed companies. The total market capitalization was $160 million, and average daily turnover was approximately $75,000 a day. So, go forward 10.5 years, there are two markets, total of about 720 listed companies, total market cap of about $50 billion, an average daily turnover anything between 75 million and a couple of hundred million on a very good day. So it's been an interesting journey, still really only at the very beginning of it, and we're looking forward to the next 5 years, I guess.
Okay, great. Now, in 2011, monetary policy quite significantly changed to aiming for more longer, more substantial growth.
Yeah.
Can you elaborate on this policy and how it's affected Vietnamese investment?
Sure. Well, basically the government for 15 to 20 years had a very simple and straightforward monetary policy, which was growth above everything. So all the planks in the platform, if you like, were designed to ensure that Vietnam grew at around 7%, or the GDP grew at around 7% plus per year. But that caused, increasingly, it was causing mini boom-bust cycles, where inflation in 2008 at 28% and 2011 23%. So that as the cycles were getting shorter, so the government felt that it was time to do something to achieve more sustainable long-term development of the economy. And so they introduced a platform which aimed to achieve that, and initially through high interest rates, but also by restraining credit growth, which obviously has an inflationary impact, and that's had a very good effect. As Vietnam has started to move up the value chain in terms of its manufacturing or its production, so the control that the government has exercised on the economy has helped that process. So now we've seen inflation now at just below 5% on an annualized basis. We've moved from trade deficit to trade surplus a couple of years before anybody expected us to, and the currency, which had been extremely weak, partly as a result of those two pressures, has for the last 2.5 years or so been the most stable currency in Asia. So, they've made some significant achievements, and since certainly 2012, the market started to notice that the improvements were coming through. The index was up 19% in 2012. It was then up 21% last year, and somewhere around 15-16% year to date. So we're in our third year of a bull market, essentially. So it all feels pretty good going forward as well.
Definitely. Could you discuss the potential pitfalls and benefits for both ETFs and alternative investment? What do you think is the better option?
Well, obviously, I'm going to be slightly biased in favour of the funds that we manage. The problem with the ETFs is not entirely due to their own making, but because Vietnam has foreign ownership limits, and so it's 49% in the listed market, 49% for everything except banks, and 30% for banks. Now, we expect those limits to be relaxed at some point, hopefully quite soon, before the situation becomes worse, because the longer it goes on, the more companies that get to the foreign ownership limit, the more difficult it becomes to trade Vietnam as a whole. Now the ETFs are restricted in what they can own because they can't own stocks at the foreign ownership limit, because basically they are baskets of investable stocks, and stocks at the foreign ownership limits are by definition non-investable by foreigners, or at least not without some difficulties. And so the performance of the ETFs has been pretty awful. And if you look at, for example, over the last 5 years against Vietnam Emerging Equity Fund, just as one of our products, which is not the best performer, but the Vietnam Emerging Equity Fund over the last 5 years is up somewhere around 36-37%, and over the same period the DBX tracker, which is based on the FTSE Vietnam Investable Index, is down about 39%. So there is a huge diversity which in performance, which comes from the restrictions in access essentially. So we think where you're able to, then having broader access to the market, and there will soon be an onshore ETF which will not be, we're told, will not be subject to the foreign ownership limit. So that may reduce the attractiveness of those offshore ETFs, and if they start contracting in size, then they have to sell stock, and so the stocks that they own will be under pressure, and the performance will continue to be pretty appalling. So yeah, I mean, we would suggest that if you're able to open an account in Vietnam, which is a fairly difficult process, it can take for institutions between 3 and 6 months, and occasionally even longer, to get a trading code, which you need to be able to buy listed equities in Vietnam, or obviously from our perspective, the much better idea is to come through a fund. Now, obviously, we're a foreign investor, but because we've been there as long as we have, we've owned all the stocks that have got to the foreign ownership limit before they got there, and we're a very long-term manager. Our portfolio turnover rate is less than 20% a year, and we tend, what we've tried to do is to build baskets or portfolios of the highest quality stocks available in Vietnam for the long term, and hopefully so far, given our relative performance against the index, that's been proven to be not too idiotic an idea.
Of course. Now, Vietnam has obviously been in the news quite a lot recently because of its dispute with China and then the subsequent protests. How has this affected your approach, and what's the situation like now?
Well, in terms of the protests, it was pretty much a possibly 2-day thing. It was very unusual that the government allowed protests against China. They got somewhat out of control, and then the government stepped back in and took control and decided that the long-term impacts of the issues that were happening in the industrial parks, with some factories being burnt down and so on, would be very negative for Vietnam. Vietnam is to a large extent dependent on China for its trade. So, for example, Vietnam's second largest export in terms of value is garments and footwear, and a lot of the textiles are imported from China. Now, they could replace those imports from India and Korea, for example. It's somewhat a higher cost, but more particularly over the last 2 or 3 years, a new type of production has essentially come from nowhere. So Vietnam in 2012 assembled roughly 24% of Samsung's global smartphone production. And that increased last year, and Samsung continue to invest in the country. And as they come in, and as they, last year were 16% of Vietnam's total exports, as they start to increase their production, as they start to increase their investment, so associated industries spring up around it. So as other electronics manufacturers see that Vietnam is able to produce their products efficiently, and this includes Intel and Foxconn and people of that nature, then we see more investment inflows, or FDI, foreign direct investment. But if it's perceived that Vietnam has a problem because of unrest in industrial parks or in the country in general, then that will have a damaging effect. And now all of the components that go into smartphones are made in China. And until Vietnam is able to manufacture those components itself, it's very dependent on China. And if 16% of its exports suddenly disappear because it's having a dispute with China, then GDP will contract. And the Vietnamese are very pragmatic, and I think they very quickly realised that this was giving them, starting to give them a slightly negative press outside of Vietnam. And so, since the beginning of May, it's been really relatively calm. And the Vietnam index came down, having peaked in March at about 609. Came all the way back down to 509, and 2 days ago it was back above 600. And China has apparently been having some live firing drills in the Eastern Sea, or as the Chinese call it, the South China Sea, as everybody else calls it, the South China Sea, and that's obviously created a little bit of nervousness. But I think that over the next few days that will calm down. So the index has come down from just above 600 to just below 590 on that. And we'll see where we go from here. But I think given that the micro is as strong as it is, and given that the performance of companies and the development of the economy as GDP growth is starting to pick up again, I think we'll see that confidence returns fairly quickly.
Kevin, once again, thank you very much for joining us.
It's a great pleasure. Thank you.
And thank you for watching. Do make sure you keep clicking back to Dukascope TV for plenty more updates and exclusive interviews. Bye for now.